If you've been thinking about retiring early or just want to make work optional sooner, this video is for you. I'm going to walk through 7 of the most expensive retirement myths I hear from people who want to retire early. Myths that could literally cost you hundreds of thousands of dollars if you believe them. And even worse than that loss in money is the loss in time spent worrying about these decisions. So let's go over the 7 myths, what makes them wrong, and how you can avoid those pitfalls. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. The first myth that most people hear is that you need some sort of arbitrary number like $2 to $3 million just to retire early, and that's really paralyzing to people. They hear a headline saying you need $2.5 million to retire comfortably and immediately think, well, I'm nowhere close to that, so I guess early retirement is off the table for me. But that's not really how retirement planning works. What you actually need is a strategy to produce the income you want, not some arbitrary portfolio number. Let me give you 2 examples. There's client A. They retired early with a $900,000 portfolio because they only want to spend $60,000 a year and had rental income covering $25,000 of that. So they needed to cover the other $35,000 or so with the $900,000 portfolio they had, which is a very doable number. Client B, on the other hand, had $1.8 million saved, but still couldn't afford to comfortably retire because they wanted to spend $150,000 a year and had no other income sources. So it depends on how much you want or need to spend versus just some random portfolio number growing to a certain level that allows you to retire. It's more of what your expense and income flow looks like as opposed to just that arbitrary number. So let's start by defining what you want to spend, then build a plan to reverse engineer the income to get there. And to expand this even more, you need to back solve your needed portfolio by thinking how much money you want to spend every year. Let's say you have fixed expenses of $4,000 a month. This includes things like food, shelter, transportation, utilities, anything that you would need to survive. Let's say you want to spend another $2,000 a month on top of that. So after tax, you need $6,000 a month or $72,000 a year. And for the sake of simplifying this example, let's assume you have a $2 million portfolio all in a traditional IRA and you receive $1,500 a month in pension after tax. That means you need to pull from your portfolio $4,500 a month after tax in order to meet your spending need, or roughly $54,000 after tax a year. And assuming you have a tax burden of 20%, you'll need to distribute about $68,000 from an IRA in order to make all of that happen. And at a level where you have a $2 million portfolio and you're taking $68,000 a year from, that's a very sustainable withdrawal. It's about 3.4% of the overall portfolio. And there's a good chance your assets will last you all of your retirement. But if you had a portfolio that was half the size, let's say $1 million, and you needed that same $68,000 a year, it's very unlikely that your portfolio would last the 25 to 30 years you would need it to maintain your entire retirement. That's why it's so important to think about what you need to spend and what you want to spend, and then back that into the portfolio you have. That way you can understand whether your savings is enough to cover all those numbers. If it is, early retirement's on the table. If it's not, you have a few more working years ahead of you. Another common myth I hear is that you can't access your 401k before you turn 59 and a half. This also applies to your IRA, and this is totally false. This one keeps people working longer than they need to. There are actually 2 ways to access your retirement accounts penalty-free if you know the rules. The first rule is the rule of 55. If you leave your job the year you turn 55 or older, you can start withdrawing from your employer's 401k without a 10% penalty. But there is a catch. You can't roll that money into an IRA and still do this. It has to stay in the plan. That's where most people mess up. So if you're, let's say, 56 and you just left your job and you kept the money in your plan, you've got full flexibility on how much you can take out. And then once you turn 59 and a half or 60, you could roll that money into an IRA and you still have complete control over it. This is a huge planning point. Retirement is all about flexibility. If you meet with an advisor who recommends a 401k rollover and early retirement as a part of your plan, make sure to ask them why that's their recommendation. If you're like most workers, you're going to have the bulk of your wealth tied up in your 401k or your 403b. Rolling it over before you turn 59 and a half can cause serious consequences if you retire before then. It will help you understand whether your advisor has your interest in mind or just their pocketbooks in mind. Now, the second rule here is that you want to be aware of is the substantially equal periodic payments rule, or the SEP rule. And if your money is in an IRA, the rule of 55 won't apply, but this SEP rule does. If you want to withdraw penalty-free before the age of 59 and a half, you can from your IRA as long as you commit to a fixed annual distribution using one of the IRS's approved methods, the amortization method, the annuitization method, or the required minimum distribution method. It's a lot stricter and it involves a little bit more planning, but it gives you access when you need it. I only recommend this one if you're working with a pro, because once you start, you have to stick with it for at least 5 years or until you turn 59 and a half, whichever one is longer. But it can help float you those early retirement years without a penalty. And that's why it's very important to know this rule, because it could allow you to retire earlier than what you previously thought. Now, the third myth that I hear is that if you retire early, you can't keep contributing to retirement accounts. And surprisingly, this one's false too, at least if you have a spouse. If your partner is still working, they can contribute to a spousal IRA on your behalf. That means you can continue funding an IRA, traditional or Roth, using their earned income. So if you're 55, you just retired, and your spouse keeps working another few years, you can still contribute to retirement accounts and reduce your household taxable income. Now, this is really important if you don't need your money in your portfolio to survive, to live on. And if your spouse's money can cover most of your expenses, if not all of your expenses, that's when you'd want to consider doing this to tax shelter more money or get more money into a Roth for later on in life. So just be cognizant that you need to have ample cash flow to do this, but it is still an option for you. Now, the next myth that I hear is that healthcare costs will wreck an early retirement. And this is the number one fear that I hear from most early retirees, or people at least thinking about early retirement, and I get why. If you're not yet eligible for Medicare, healthcare costs can feel like a black hole of cost, but it doesn't have to be. With smart income planning, you can dramatically lower your premiums by qualifying for ACA subsidies. How do you do it? If you retire early and you start drawing from a brokerage account, also called a non-qualified account, you're pulling money that is taxed at a capital gains rate as opposed to ordinary income tax rates. That means your income on paper looks much lower, even if you're still spending the same $70,000 or $80,000 a year you need. And a lower modified adjusted gross income equals higher subsidies. I have seen investors retire early and pay something like $10 or $20 a month for a gold level plan. And that's not a typo. They did the planning years in advance, and you can too. And as a byproduct of this type of strategy, you can oftentimes pay little to nothing in the way of taxes if you keep your distributions below the capital gains thresholds. So it's a way to not only make your money last longer and afford more health care, you can also make it last longer by the way of paying less in tax over your lifetime. Now, the fifth myth is the 4% rule is your best bet. And this rule says that you withdraw 4% of your portfolio balance each year, and you should be good for 30 years. And then after the first year, you adjust that for inflation. So if inflation was 10%, let's say it was a really bad year, essentially your withdrawal would grow by 10%. So if you have 4% of your $1 million portfolio is $40,000 in year one, in year two, you would take out $44,000, then you would keep adjusting that for inflation year after year. But if you're retiring at 55 and you expect to live into your 90s, that's a 40-year retirement. The 4% rule wasn't built for that. Instead, I use what's called a guardrails approach. Here's the idea. You build a really well-diversified portfolio, small caps, dividend players, REITs, and some international exposure. You plan for flexibility, adjusting spending based on market performance. For example, in great years, when the market does really well, take that extra vacation and pull out a little bit more. In down years, you want to rein in spending a little bit. This approach will allow you to spend more in years when the market's good and rein in that spending in years when the market's bad, and still plan for a 40-year retirement while staying within safe limits. Think about it like bowling with bumpers. We keep you from going off track, but you still get to aim for the strike. It's also important to keep in mind the retirement spending curve. In retirement, you typically spend more in your 60s and a little bit less in your 70s and even less in your 80s. When retiring early, you have to factor in your 50s and all of your 60s, so you will spend more for longer, but then you will still follow that same curve. The biggest reason I see spending pick back up later in life, though, is a long-term care event. So before you retire early, make sure you're saving enough to either self-insure or you're buying insurance policy to cover yourself there so it doesn't completely derail your plan later in life. Now, the sixth myth that I see is more psychological than financial, and that's the fact that you think you're going to be bored in retirement. But it's just as important. I've had dozens of clients say, I'm scared I'll just sit around and waste my time and do nothing. Then 6 months in, they're busier than ever, volunteering, spending more time with family, starting businesses, and traveling. The truth is, if you're bored now, you'll be bored in retirement. If you're already living with purpose and energy, you'll be fine. Retirement just gives you more time to do it. Plan for what you're retiring to, not what you're retiring from. Now, the last myth that I hear from a lot of clients is that if they're in their peak earning years, they just can't walk away from that salary. And this is the hardest one to let go of. You've worked your way up, you're making more money now than you ever have, and walking away from that income can feel like a betrayal of all the decades of hard work from the previous few years. But if you've saved enough, if you've already hit the finish line, then what are you still running for? One client said, I dreamed of making $200,000 and now I don't even want it. If you're working purely for money, you likely don't need it. And you're sacrificing your health, your family, and your freedom in the process. It might be time to reframe what winning looks like for you and decide whether to scale back at work or retire altogether and start putting your energies to something more fulfilling. So let's recap all 7 of the early retirement myths. First is you don't need $2 to $3 million to retire. You just need an income plan. Second, You can access retirement accounts before 59 and a half if you know the rules. Third, a spousal IRA allows you to keep contributing to your retirement accounts even after you no longer work. Healthcare costs don't have to be $1,000 a month with smart planning. The 4% rule is outdated. Just use guardrails instead. Sixth, you won't be bored if you retire with purpose. And seventh and finally, staying in your highest earning years out of fear might be costing you more money than you think. If this video was helpful and helped you clear up some of the noise around early retirement, please like and subscribe to the video and drop a comment below. And if you want help building your early retirement roadmap, I'd love to work with you. Click on the link to book a call below. See you in the next one.